Do you know any level 2 investor optional? Level 3 smart investors. There are three different types of investors in this group. The level of investors is aware of the need of invest. They may even participate in the company retirement plan 401k, SCP, superannuation, pension, etc. Sometimes they even have outside investment in mutual fund, stock bonds, or limited partnership. Generally, they are intelligent people who have a solid education. They make up the two-third of the country we call the middle class. However, when it comes to investing, they are often not educated or lack what the investment industry calls sophistication. Rarely they read a company annual report or company prospectus. How could they? They were not trained to read financial reports. They lack financial literacy. They may have advanced college degrees and may be doctor or even accountant, or few have even been formally trained and educated in the win-lose world of investment. These are the three main categories in this level. They are often smart people who are well educated and often make substantial income, and they do invest. Yet there are differences. Level 3A. People in this level make up the I can't be bothered group. They have convinced themselves they don't understand money and never will. They say things like, I'm just not very good with numbers. I'll never understand how investing works. I just too busy. There's too many paperwork. It's just too complicated. Investing is too risky. I prefer to leave the money decision to the professionals. It's too much of a hassle. My husband wives handles the investment for our family. These people just let the money sit and do little in their retirement plan to turn it over to a financial planner who recommend diversification. They block their financial future out of their mind, work hard day to day, and say to themselves, at least I have a retirement plan. When they retire, they'll look at how their investment did. Did you know any level 3 investor optional? Level 3B, the second category is the cynic. These people know all the reasons why an investment will not work. They are dangerous to have around. They often sound intelligent, speaks with authority, are successful in their chosen field, but are really coward under their intellectual exterior. They can tell you exactly how and why you will get swindled with every investment known to man. When you ask for their option on a stock or other investment, you walk away feeling terrible, often afraid or doubtful. Their most commonly repeated words are, well, I've been taking before. They are not going to do that to me again. They often drop names and say things like, my broker at Merrill Lynch or Dean Witter. Naming dropping helps cover their deep insecurity, yet strangely, these same signings often follow the market like sheep at work. They have always reading the financial pages or the Wall Street journals. They read the papers and they then tell everyone else what they know at the coffee break. Their language is filled with the latest investments, jargon, and technical terms. They talk about the big deals but are never in them. They look for stocks that makes the front page, and if the report is favorable, they often buy. The problem is they buy late because if you get your news from newspaper, it's too late. The truly smart investors have bought way before it makes the news. The cynic doers not know that. When bad news comes, they criticize and say things like, I knew it. They think they are in the game, but they are really only a spectac- spectator standing on the sideline. They often want to get into the game, but deep down they are terrible afraid of getting hurt. Security is often important than fun. Psych, 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 psychiatrists report that cynicism is the combination of fears and ignorance, which is turn cause arrogance. These pupils often enter major market savings late, waiting for the crowd or a special social proof that their investment decision is the right decision. Because they wait for social proof, they buy late at market tubes and sold at the market bottom just as the market crashes. They label buying high and selling low as getting swindled again. Everything they were so afraid happening happens again and again. Signings are often what professional traders call pigs. They secure a lot and then run to their own slaughter. They buy high and sell low. Why? Because they are so smart. They have become overly cautious. They are smart but are terrified of taking risks and making mistakes. So they study harder, get smarter, and the more they know, the more risks they see. So they study even harder. The cynical caution causes them to wait until it's too late. They come to make when greed financially overpower their fear. They come to the through with the other pigs and get slaughtered. But the worst part of the cynic is that they infect the people around them with their deep fear, disguise, and as intelligence. When it comes to investing, they can tell you why things won't work, but they can't tell you how it would work. The world of academia, government, religion, and multimedia are filled with these people. They love hearing about financial disaster or wrongdoings so they can spread the words. They are truly Monday morning quarterback when it comes to investing, yet rarely do they have anything good to say about financial success. A cynic finds it easy to discover what is wrong. It is their way of protecting themselves from revealing their lack of knowledge or lack of courage. The original cynic were an ancient Greek sect despised because of their arrogance and sarcastic contempt for merit and success. They were nicknamed the dogmen. Cynic comes from the Greek word for dogs. When it comes to money, there are many dog people, many who are smart and well educated. Be careful about allowing dog people to squelch your financial dreams. While is it true that the world of money is filled with crooks and conmen and charlatans? What industry isn't? Is it possible to get rich quickly with little money and with little risks? It is possible, but only if you are willing to do your part to make it possible. One of the things you need to do is keep an open mind and be aware of cynic as well as con men. They are both financial dangerous. Do you know any level 3B investors? Market about the same way they look at a Las Vegas craps tables. It just like throw the dice and pray. This guru has no set trending rules or principles. They want to act like the big boys, so they fake it until they make it or lose it all. The latter is most probable. They are searching for the secret to investing or the holy grail. They are always looking for the new and exciting ways to invest in instead of long-term diligence and study and understanding. They seek tips or shortcuts. They jump into a commodities, initial public offerings, IPOs, penny stock, gas and oil, cattle, and every other investment known to mankind. They like to use sophisticated investment techniques such as margin, puts, calls, and options. They jump into the game without knowing who the players are and who makes up the rules. These pupils are the worst investors the planet has ever known. They always try to hit a home run. They usually strike out when asked how they are doing. They always are about even or a little bit up in actually they have lost money, lots of money, often huge amount of money. This type of investor loses money over 90% of the time. They never discuss their losses, they only remember the killing they made 6 years ago. They think they were smart and failed to recognize they were merely lucky. They think that all they need is the one big deal and then they'll be on easy street. Society call this person an incurable gambler deep down, and they are simply lazy when it comes to investing money. Do you know any level 3C investor? Optional. Level 4 long term investors. These investors are clearly aware of the needs of invest. They are actively involved in their own investment decision. They have a career laid out long-term plan that will allow them to reach their financial objective. They invest in their education before actually buying an investment. They take advantage of periodic investing and whenever possible invest in a tax advantage way. Most important, they seek out advice from competent financial planner. Please understand this type of investor is not what you would think of as some big time investor. Far more it is doubtful that they are investing in real estate, business communities or any other exciting investment vehicles. Rather they take the conservative long-term approach recommended by investors such as Peter Lynch of Fidelity, Magellan Fund fame, or Warren Buffett. If you are not yet a long-term investor, get yourself there as fast as you can. What does this mean? This means that you sit down and map out a plan, get control of your spending habit, minimize your debt liabilities, live within your means, and then increase your means. Find out how much invested per month for how many months at a realistic rate of return it will take to reach your goals. Goals such as at what age do you plan to stop working? How much money will you need per month? Simply having a long-term plan that reduces your consumer debt while putting away a small amount of money on a periodic basis into a top mutual fund will give you a head start on retiring wealthy. If you start early enough and keep an eye on what you are doing at this level, keep it simple, don't get fancy, forget the sophisticated investment, just do solid stocks and mutual fund investment. Learn how to buy closed and mutual funds soon if you haven't already. Don't try to outsmart the market. Use insurance vehicles wisely as protection but not as wealth accumulation. A mutual fund like the Vanguard Index 500 fund, which is the past, has outperforms two-thirds of all human funds years in and years out, is worth using as a benchmark over 10 years. This type of fund may give you a return that exceeds 90% of the professional mutual money managers by mutual funds money managers. But always remember, there is no 100% safe investment. Funds have their own inherent tragic flaws. Stop waiting for the big deal. Get into the game with the small deals, like my first small condo that allowed me to start investing for just a few dollars. Don't worry about being right or wrong at first. Just start. You'll learn a lot more once you put some money down, just a little to start. Money has a way of increasing intelligence quickly. Fear and hesitation retards you. You can always move up to a bigger game, but you can never get back the time and education you lost by waiting to do the rights or make the big deals. Remember, small deals often lead to bigger deals, but you must start. Start today, don't wait. Cut up your credit cards, get rid of dudes and call a good no load mutual fund. Also, there is no such thing as true no loss fund. Sit down with your loved ones and work out a plan, and call a financial planner or go to the library and read about financial planning and start putting money away, even if it is only $50 a month for yourself. The longer you wait, the more you waste one of your most precious assets, the intangible priceless asset of time. An interesting note, level 4 is where most of the millionaires in America come from. The book of The Millionaire Next Door describes average millionaires as driving a Ford Taurus, owning a company, and living within their means. They study or are informed about investing, have a plan, and invest for the long term. They do nothing fancy, risky, or sexy when it comes to investing. They are truly conservative, and their well balanced financial habits are what make them rich and successful over the long haul. For people who don't like risk and would rather focus on their profession, job, or career instead of spending a lot of time studying the subject of investing, level 4 is must. If you want to live a prosperous and financial abundant life. For these individuals, it is even more important. Seek the advice of financial planner. They can help you develop your investment strategy and get you started on the right track with a long-term investing pattern. This level of investors is patient and uses the advantage of time. If you start early and invest regularly, you can make it to a phenomenon phenomen, phenomenal wealth. If you start late in life, past age 45, this level may not work, especially between now and the year of 2010. Do you know any level 4 investor optional? Level 5, sophisticated investors. These investors can afford to seek more aggressive or risky investment strategies. Why? They they have good money habits, a solid foundation of money, and also investment savvy. They are not new to the game. They are focused, not usually diversified. They have a long track record of winning on a consistent basis, and they have had enough losses that give them the wisdom that only comes from making mistakes and learning from them. They are the investors that often buy investment wholesale rather than retail. They put their own deals together for their own use, or they are sophisticated enough to get into the deals that their level 6 friends have put together that needs investment capital. What determines whether people are sophisticated? They have a financial base that is sound from their possession, business, or retirement income, or have a base of solid conservative investment. These people have their personal debts equity ratios in control, which means they have much more income than expenses. They are well educated in the world of investment and actively seek new information. They are cautious yet not cynical, always keeping an open mind. They risk less than 20% of all their capital in speculative ventures. They often start small, putting a little money down so they can learn the business of investing, be it stocks or business acquisition or real estate syndication, buying, foreclosure, etc. If they lost this 20%, it would not damage them or take food off their table. They will look at the loss as a lesson learned from it and get back into the game to learn more, knowing that failure is part of the process of success. While hating to lose, they are not afraid of losing. Losing inspires them to have move forward, to learn rather than to dive into their emotional cave and call their attorney. If people are sophisticated, they can create their own deals with returns of 25% of infinity. They are classified as sophisticated because they have the extra money, a team of hand-picked professional advisors, and track record to prove it. As mentioned earlier, investors at this level put their own deals together, just as there are some who buy computers right off the retailer's shelf. There are some people who buy component and create their own customized computer system. Level 5 investors can assemble their investment by bringing different components together. These investors knows that bad economic times or market offers them the best opportunities for success. They get into market when others are getting out. They usually knows when to get out at these levels and exit strategy it more important than entry into the market. They are clear on their own principles and their rules of investing. Their vehicles of choice might be real. Discounted papers, business bankruptcies, or new issues of stocks. While they take risks greater than the average person, they abhor gambling. They have a plan and specific goals. They study on a daily basis. They read the newspaper, read magazines, subscribe on investment newsletters, and attend investment seminars. They actively participate in the management of their investment. They understand money and know how to have money work for them. Their main focus is on increasing their assets rather than investing so they can make a few extra bucks or to spend. They reinvest their gains to build a bigger asset base. They know that building a strong asset base that throws off high cash yield or high return with minimal tax exposure is the path to great long term wealth. They often teach this information to their